Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have had a very interesting day here in the wake of the Fed policy announcement, arguably the most focal point for macro event risk this week. The Fed coming out and basically saying, maybe we're going to have fewer rate hikes than we thought last go around, but inflation fighting remains the focus. And we're going to deal with whatever banking issues occur episodically as they present themselves. We have the tools to do it, but it is inflation fighting that we're focused on, which is exactly what we've been talking about here on Macro Money in the past 2 weeks or so, that even as we get this bank stress, the Fed has an inflation issue. Other central banks have an inflation issue. They need to continue that fight in their view of it, and that's how they're going to go and approach this. Now, the marathon for this narrative actually continues. So we've now had the ECB last week stick this landing. We arguably have had the Fed do the same. It doesn't look like in the wake of what it has done, there has been anything like a massive dislocation in markets. And so now the question and the spotlight turns to the Bank of England. We're going to find out if it too is a happy inflation warrior, if it too is prepared to press onward. Now, this, of course, will be very, very important because it will be the first test for how the market's on board the Fed. And this was always the key question here. The Fed is fundamentally the most important central bank here, not because I'm sitting here in the U.S. and want it that way, but because the dollar accounts for 80+% of global monetary transactions, according to the Bank of International Settlements, which is kind of a central bank for central banks, a sort of central clearing house for central banks. And so what you then have is a situation where when the Fed raises rates, in response to whatever is going on domestically in the United States, of course, that is its mandate. What it's doing is it's increasing the cost of borrowing dollars. And since the dollar is the ubiquitous medium of international commerce, the absolutely go-to vehicle for exchange and for transacting, what happens when the Fed does that is an increase in borrowing costs writ large, everywhere, independent of what local central banks may or may not do. And so for the Bank of England, this now is an environment where the Fed has already come out, ostensibly different than it was for the ECB, which moved ahead of the Fed. And so what you have with the ECB is a situation where you're a bit more complicated on the sovereign risk side of things. If you raise rates too quickly, maybe you start to have concerns about some members of the Eurozone bloc looking a bit shaky on their debts, looking like they might have some trouble paying those back. Italy, we're looking at you. But that's not the case, clearly, with the Fed. It's not the case with the Bank of England either. It is certainly the case that banking crises impact everybody. And so this will be the first test of a market environment where the ECB has said our focus is inflation. We're pressing on with rate hikes. They got a bit of a reprieve there, maybe because the Fed hadn't occurred yet, and so there was some hope that the Fed might be more dovish and maybe enable the ECB to say such things. Well, the Fed is now out, and it has said, actually, no, we're focused on inflation too. We're going to press on with rate hikes. It might not be as many rate hikes as we were going to consider before this banking collapse, but you markets are still extrapolating significant rate cuts for the back half of this year, and we're not looking at doing that. So for the Bank of England, this is a bit of a different environment to wade into now. And so what we're going to do is we're going to look at the specifics for the Bank of England itself, and then we're going to see whether they can perhaps also hope to stick this landing without significantly upsetting markets, or if what we're going to hear here will so reinforce this sense that central banks are willing to let some degree of economic crisis occur as long as it's able to be managed, and have that be the cost of beating inflation, whether that part of it really starts to settle in as risk aversion and a defensive view for markets. So let's see what the specifics are. For the Bank of England at this point, one rate hike is almost all the way baked in. You can see in that number of hikes cuts column, 0.91 means that we have 91% of a 25 basis point hike baked in. So you can see in the implied rate delta column there, 0.23. So essentially all but 2 basis points of the hike already baked in. Looking down the number of hikes cuts column, you can see that by May, you have one hike there, that's ostensibly this hike, and 66% chance of a further. By June, you have 2 hikes there, and a 24% chance of a further. The peak seems to occur in September, where 2 hikes are in, and there's about a 67% chance, 66, 67, of a third. And from there, things begin to fade. So the peak in rates seems to be in September at about 4.6%. So that's somewhere straddling the line between 4.5 and 4.75, 4.75. And at this point, it looks like we're narrowly leaning in favor of the higher outcome. So about a 67% chance that we could end up at 75 rather than 50, but we're not quite there. The key is how all of this has evolved in the face of economic data, as well as in the face of this financial stress that we have seen. So consider here in the orange and the yellow, the orange and the red rather, the expectations for what the rate is going to be at the Bank of England in August, so for that meeting, and September. And as we said, September looks to be the peak in rates at this point. You can see that we have aggressively rebounded in the past several days, and that has come against the backdrop of the OFR Financial Stress Index, which is from the Office of Financial Research with the U.S. government. That has significantly come in, telling us that the markets believe this bank crisis episode is receding. You can see that rate hike odds absolutely plunged as that index started to march higher with those SVB concerns, with the closure of Signature Bank in New York, with the steps being taken to shore up First Republic, with the merger or the takeover, depends on the parlance that you prefer and the bank that you prefer giving it, where Credit Suisse, the second largest Swiss lender, has now been absorbed into UBS, the number one largest. So clearly the markets think, okay, central banks are not terribly perturbed. They keep fighting inflation as the main focus of what we've heard so far. So what we're looking at then seems to be receding crisis risk, and you can see that here. You can see rate hike odds in the face of that occurring, rebuilding significantly. And when you look at the yield curve, we now have a yield curve for the UK that is both steeper than it was a week ago, which is probably not a big shocker, but more importantly, much steeper than it was the last time that the Bank of England met, which was nearly 2 months ago. So the view here very clearly anchored toward the hawkish side, it seems. So there's that peak at 466. You can see it's occurring about 6 months from now, so September, as we said. And then you have a rate cut path that follows, but it is a shallower rate cut path than anything that the Bank of England signaled at the beginning of February. So rates now settling a good 50 basis points, 50 to 75, if you look at that 3.59 number, but modestly speaking, let's say a good 50 basis points higher ultimately over a 3-year window than what was anticipated a month ago. Part of that has been the pickup in economic activity. And of course, that pickup has helped to drive inflation. So you can see here, this is UK CPI overlaid with the market's inflation expectations. You can see that we are in that phase where on the inflation expectations, there was a pop there. So there was a bit of a rebound in inflation after an initial swing lower. And again, CPI here is lagged 7 months to these expectations, which are themselves in real time. And so you can see here, we're starting to follow that path. So the number this week out of the UK was expected to be a decline. It actually ended up surprising on the top side and giving us an inflation number back above 10%, 10.1, which is, of course, a blisteringly fast rate of inflation. So what we're looking at here is inflation that hasn't quite turned a corner, but which does seem to be following the pattern laid out in break-even rates. These, just to quickly remind, are extracted by taking the difference between nominal bond yields and real bond yields, so those bond yields adjusted for inflation. When you take that difference between nominal and real, you get the inflation adjustment value needed to take it from nominal to real. And so once you take that difference, you get the implied inflation expectation, which the bond market is flagging for you. So this essentially tells you that over a 5-year window, what we're expecting is the Bank of England will drive inflation somewhere toward the mid-3 range. Still above target, but of course better than 10. And with about a 7-month lag for realized CPI, we seem to be broadly tracking those expectations. So a little bit higher on the inflation front this week. Expectations indicated that might be the case. We could see perhaps some more inflation coming down in the coming month or two. But then, looking at expectations, one would expect a turn lower. So it does look like maybe things are approaching some kind of sense of containment. However, economic activity is on the rise. That, of course, has inflationary implications. When the economy speeds up, that's a pickup in the amount and pace of money changing hands. That can be inflationary and often is. So you can see that although manufacturing is still lagging for the latest set of PMIs, it's still under that 50 mark, which denotes the difference between a sector expanding or contracting in the logic of PMIs. Under 50 is contraction, above 50 is expansion. The more you go, the higher you go above 50, the faster the expansion. The lower you go under 50, the faster the contraction. And so you can see here a picture of an economy improving. So On the manufacturing side, even where you're still under 50, you've had a few months of that number getting closer to 50. So coming off numbers that are deeper into the 40s and approaching 50, so improving. You can see that, as with most major economies, the service sector is the biggest component of what's going on. And so not surprisingly, the composite number that subsumes both services and manufacturing, that composite looks the most like the service index. And here, you're well above 50, and in particular for the past month, so in particular in February, things looked quite strong. So we've jumped to 53.1. That's the kind of thing that might juice inflation. Looking at overall economic performance, this is the UK Economic Surprise Index, data from Citigroup. You can see here how reactive markets have been to a pickup in how economic data has done relative to expectations. So you can see that CPI surprise there this week marked off by a significant spike. That's economic data registering higher than anticipated and also being market moving. This index is especially good because not only does it take into account how data performs relative to forecasts, it introduces an additional factor that adds weight to numbers that are market moving. And so you can see here UK economic performance, a kind of pulse, if you will, on how the economy is doing. That's showing you improvement, which, and at this point fairly brisk improvement, which implies again a degree of inflationary concern. Next, the Bloomberg UK Financial Conditions Index still seems to point to a relatively loose outcome. So when we see the yellow bars there, so the index is above 0, that tells you that lending conditions, credit conditions, are looser than average. When you are under, and the bars are in the dark gray, that would be conditions are tighter. And not surprisingly, you can see through the back half of last year, you of course had tremendous political turmoil in the UK, and so there was more of a risk premium to lending, so conditions were tighter. You can see that they've been improving steadily, and what you're looking at now is conditions that are actually looser than average. If you squint really closely, you can see that in the past several bars, there is a lone blue bar at the tail end here, right there. And that's the banking crisis that we've just had. So a blip on the radar. Meanwhile, the overall setting of these conditions is on the loose side. So inflation is high, double digits. The economy is doing well. It seems to be improving, looking at economic data. And credit conditions seem to be looser than average. So here we have a situation where the Bank of England is ostensibly set up to come in and follow the ECB and the Fed's lead, to issue their rate hike and to signal that more is probably in the cards. Here's how the British pound has looked. This is the 6B future relative to the US dollar, of course. This contract is priced in USD through this whole episode. You can see very interestingly here, there appears to be something of a range. So top of the range, we'll call it 124.62. Bottom of the range, we'll call anywhere between 118 to about 118.60. So those seem to be the recent swing lows. The most recent move within this range has been an upswing from that low at 118.03 into the top part of the range, you can see resistance there somewhere between 123.20 and 124.60, give or take. So we've moved into that area. But what we're going to have here today then is a Bank of England that either registers more hawkish because it has had the green light and it's had a hot inflation number, or that basically sticks with where things currently stand, gives us the 25 basis points that's already baked in, pays the same lip service to the need to episodically backstop areas of the credit space that end up being weak as a consequence of this tightening, but ultimately to proceed forward. It'll be interesting to see then what the response is going to be, because again, we are a bit aligned here for some kind of decisive move. So if we get under 122.22, the area where we have some initial resistance turn support here, and also the site of this near-term rising support line, which isn't there so much as to say this is a line in the sand, but more so to articulate the idea that a trend higher is defined by a series of higher highs and higher lows, and that's the line where if you were to get under it, you'd have a lower low, essentially. That sequence of higher lows would be violated if you were to get underneath that line. And so the near-term bias would be inherently altered. So we're sitting right there. If the Bank of England gives us something that's broadly status quo, that would come in the context of a Fed that ostensibly registered a bit more hawkish than people expected, evidenced, of course, in the negative response from stocks to what the Fed did, in the kind of retreat from the highs in gold that followed the Fed. And so you might get a sense here that this is something negative for the British pound. You could get a move through that 122.22 area. From a macro perspective, what that would tell you is that the market has digested and said the Fed was more hawkish. Look out below risk sentiment. Because all of the ingredients here are ostensibly for the Bank of England to actually register on the more hawkish side of things, and the market has been triangulated that way. So the bar for them to be more hawkish than even the current setup, which we've just gone over, seems relatively higher than it was for the Fed, or for that matter, for the ECB. If they choose to push the story forward and say, actually, we think that we might need to do more in terms of tightening, inflation has surprised higher than anticipated here most recently, we think there's more to do, that would perhaps justify a push toward the top of this range at 124.60, and then we'll see how that goes. But if the Bank of England does their hike, gives us the song and dance we've now grown accustomed to with the ECB and the Fed, and the pound still moves higher without anything more hawkish than what is already there, which again is ostensibly a more hawkish precondition than either the ECB or the Fed were walking into, that too would be a referendum on the Fed. Essentially saying the markets saw a bit of a weaker hand, ultimately, in what the Fed has done. And is perhaps putting more of an emphasis on what's going on with the policy statement from the Fed than the subsequent press conference with Jay Powell, where he sort of moderated any dovishness that might have been extrapolated from the text as such. So with that in mind, this Bank of England situation and how the pound behaves. Does it get to 24.60 in the wake? Does it break that perhaps? Does it break 122.20 and instead goes the other way? And what actions from the central bank are going to precede that price action response? That'll be seemingly a very important referendum, not only on what happens with the Bank of England and the pound and UK assets, but a critical lens into how the markets views the Fed and thereby risk sentiment writ large, which extends to the dollar, extends to gold, extends to global stock markets, extends to every commodity, extends to crypto, almost every commodity, I should say. Let's not forget nat gas seems to not like to dance to any beat of any drum other than its own. But those things aside, we could, in the Bank of England, have the telltale sign of what the markets have ultimately made of the Fed and how all of these critical assets, crypto certainly as well, how all of that proceeds for weeks and months to come. And so it could be an absolutely pivotal bit of insight. And that is Macro Money for today. Thank you very much for joining us. As ever, we are here Monday through Thursday, every single week. We are also here with Chris Vecchio, the head of Futures and Forex here at tastylive for overtime, just ahead of Macro Money, Monday through Thursday. I am also on with Chris for Futures Power Hour on Friday, and with Tom and Tony for First Call on Sunday evenings. In the intervening periods, you can catch me on Twitter opining at Ilya Spivak. Thank you very much for joining, everybody. We'll see you tomorrow. Take care.